Stay tuned until the end of this video to discover how the U.S. Treasury's long-end buyback program has set off a dramatic drop in yields, driving the U.S. dollar down and giving the yen a lift toward the 158 range. What implications does this policy shift hold for global assets? For months now, global currency markets have felt the weight of surging U.S. long-term bond yields, leaving the yen's isolated interventions struggling to make a dent in stabilizing exchange rates. But a significant change has emerged. The U.S. Treasury is ramping up buybacks of long-term debt while pivoting its issuance toward shorter maturities. This clear policy signal is designed to put a cap on long-end yield spikes, fundamentally reshaping the dynamics between the dollar and yen. The main driver behind this shift is the U.S. Treasury's new initiative to expand buyback operations on long-term government debt. This intervention has led to an immediate drop in long-term U.S. Treasury yields, causing the dollar to weaken across global FX markets. In response, the Japanese yen has surged sharply into the upper 158 range against the dollar. This ripple effect has positively impacted long-term bonds, equities, and even gold, showcasing a comprehensive cross-asset repricing driven directly by the Treasury's guidance. Traders on X have quickly labeled this policy shift the Bessent put, recognizing that the buybacks of long-end debt combined with shifts in short-end issuance effectively set a ceiling on yields. They noted that Japan's earlier unilateral yen interventions couldn't maintain momentum. In contrast, the active buybacks by the U.S. Treasury provide a more substantial support level. Currently, traders are closely watching key technical thresholds, with a potential break of 155 in their sights. Macro analysts point out that isolated foreign exchange interventions are limited without yield convergence. Experts emphasize that the forward guidance indicating buybacks of long-end debt signifies a coordinated approach between U.S. and Japanese policies. By preventing long-term yields from spiking, U.S. debt management directly aids in stabilizing the yen, relieving some pressure on Japanese authorities while altering global liquidity dynamics. For Japanese equities, the strengthening yen coupled with lower U.S. long-term yields creates a complex situation. Export-oriented sectors may face short-term challenges due to currency appreciation, but the overall market sentiment benefits from global stock support and reduced yield volatility. Additionally, speculation surrounding a potential interest rate hike by the Bank of Japan in September or October keeps interest-sensitive domestic sectors in focus as institutions reposition their strategies. The effects of U.S. Treasury buybacks extend well beyond just the U.S. dollar to Japanese yen pair. With lower U.S. Treasury yields, the U.S. dollar index has also dipped, triggering simultaneous rallies across equities, long-duration bond funds, and gold. However, traders caution that if U.S. dollar to Japanese yen falls below the critical support level of 155, a risk-off sentiment could lead to a swift unwinding of yen carry trades, potentially plunging into the 152 to 153 range. For retail investors, it's crucial to understand that current currency fluctuations are driven more by sovereign debt management policy than just economic growth metrics. Keeping an eye on Treasury issuance schedules, yield curve spreads, and forward guidance on buybacks is vital. Rushing into currency trades without understanding the policy underpinnings could lead to significant losses. Therefore, practicing disciplined risk management and closely monitoring central bank signals is essential. Looking ahead, AI scenario analysis has laid out 3 potential paths for the coming months. In the bullish scenario for the yen, continued U.S. debt buybacks along with a BOJ rate hike in September or October could push U.S. dollar to Japanese yen below 155, leading to a rapid unwind of carry trades down to 152 or 153. Conversely, in the bearish scenario, if buybacks aren't enough to counter inflation pressures, U.S. yields could rise, driving U.S. dollar to Japanese yen above 160. The baseline scenario anticipates U.S. dollar to Japanese yen stabilizing in the 155 to 158 range as market participants absorb Treasury guidance and prepare for upcoming policy decisions. In conclusion, the U.S. Treasury's long-end buybacks have effectively lowered yields, pushing the yen toward the 158 mark. Keep a close watch on the critical 155 support level and the forthcoming BOJ rate policy signals. What are your thoughts on this significant policy move? We invite you to share your insights in the comments below, and don't forget to subscribe for your daily macro updates.